Today, I wanted to talk about the elections and just the stock market in general. I might talk about real estate very briefly at the end of the video, but this is still a video about stocks. What really matters is fully dependent on your circumstances and what you want to be prepared for. And it really comes down to these two things. Do you need the money now, or do you not need the money now? So historically speaking, stocks have always gone up over time. It really doesn't matter who gets elected, Republican or Democrat, the market has gone up as a whole over time. This was on CNBC, measuring the Dow as a metric of how the market's doing. So with a Republican in the White House, it's been around 7% per year in growth since the year 1900. Yes, that's the last 120 years. And with a Democrat in the White House, it has been an average of 3% per year. Again, since 1900. But all in all, the market has gone up. And this is CNBC presenting only the Dow as a metric on the frame that I just showed you. This is not the S&P 500, the NASDAQ. This is just like the old, slow, 30 big, boring Dow companies. Besides maybe like Apple. This is not mentioning the big tech stocks and growth stocks that have been blowing up and on the rise recently. And when I mean blowing up, it's basically the big run that we've had since March. And even before then, if you look at ETFs like ARK Invest, their ETFs comprise of mostly these companies. So while most of these companies aren't tens of billions of dollars in market cap, they have the potential for market growth because they aren't quite there yet. A company going from, let's say, $100 billion to $200 billion is much more difficult than a company going from, let's say, $1 billion to $2 billion. Now, if that $1 billion company becomes a $100 billion company, then that's increasing by a factor of 100. Whereas 100 billion to 200 billion is also a 100 billion increase, but only a 2 times in gain. All of the things that people seem to be worrying about in the market right now are short-term in perspective. Do you need the money now, or do you need the money later? If you are in a position where you're invested in the stock market, but you're having to still worry about debts, then maybe it's not a bad idea to pull out some profits to cover those debts. The same way your investments can compound, your debts can also compound. So it's really smart to pay those down as fast as you can. Maybe your car broke down. Maybe you need a new set of tires. Maybe you need to buy some gifts for your family. It's really all based on your circumstance. But if you don't need money now, the stock market is known for rewarding delayed gratification. The longer you're able to not touch your portfolio and keep growing share count, statistically, this outperforms day trading stocks. This is based on my own experience and just things I've read online, which I can relate to because I've literally experienced this myself. The more you touch your portfolio and kind of move money around, maybe you want to get out and go into this one, but then you change your mind and then you want to put it back. Like little small moves like that, they diminish your returns by a lot. These little microtransactions and fees, they really add up. I also had a really good example of this. So when I was in high school, there was a website called updown.com. They don't exist anymore. It was a paper trading stock platform. So you could just go in and make an account and trade with a fake $100,000 or whatever amount of money you picked. But I remember in my entrepreneurship class, this was my, I think, beginning of junior year, and this was back in 2012. I remember I basically just picked stocks that I knew about, or at least companies that I knew about, and I bought their stock. I just like bought pieces. I think I distributed it evenly among the $100,000 that I had. I got companies like Google. I got companies like Home Depot, Johnson & Johnson, pretty big companies. I think these were all mostly Dow companies, if I'm not mistaken, even Exxon. But pretty much I bought these stocks and we would look at it for a little while. But I knew I was interested in stocks. I've always been interested in investing. But at the time, I definitely had no idea what I was looking for. And I just knew these were big companies that were successful for the most part. So that's why I invested in them. And if we fast forward, I'd say maybe almost full 2 years go by. And I logged back into UpDown and the account was up like 40% or 50% or something like that. And this was like $100,000. I think Google was around like $300 at that time. And right now Google's like $1,600. And I would say that's my first real experience with compound interest. It wasn't real, but it still kind of showed me what was possible. So this was a whole lot of rambling, but now I'm going to get to the good stuff. These are 3 made-up scenarios. One being if you're 100% invested in stocks. Scenario 2 being if you're 70% invested in stocks. Scenario 3 if you're not invested in stocks and holding all cash. And then a bonus scenario where I just talk about owning stocks and owning real estate. So in scenario 1, if you're 100% invested in stocks, you'll have no cash position immediately available, but that's okay because what you can do is your monthly income, you simply take a portion, you dollar cost average into the market, and then you just do that over and over and over again. In scenario one, your mindset is you don't care where the market's going. Intraday, it might fall, but in the long term, it's going to go up. Your interest is just to grow your share count and to grow your portfolio. Scenario two is you're 70% invested in stocks. Let's say stocks keep going up and you missed out on, let's say, 30% of your potential gains because you're holding part cash. It's going to be up to you to decide whether you'll control your fear of missing out or will you just wait for better opportunities? But at least now, if the market double dips, you have cash ready. Scenario three is you are not invested in stocks at all and you're holding all cash. If it goes up, you're missing on all these paper gains. If it goes down, well, at least now you're prepared. But some things right now to consider with having all cash and no investments. First of all, savings accounts are practically paying no interest right now on your money. The reason being because of this whole CV-19 situation, the federal funds rates are at record lows right now. And if you leave your money in these accounts, it's basically going to wither away due to inflation. This is why you see so many people investing in stocks right now and real estate. And this is where I talk a little bit about real estate. Owning real estate is a low risk, high reward investment. And this is mainly because of the finite characteristic of real estate. There's only so much land that we can have on the planet. Real estate, however, is not very liquid, meaning you can't just go to a pawn shop and sell your house. There's a process to selling real estate. It's the biggest purchase most people make in their lives, and selling a house in a normal traditional process takes between 3 and 4 weeks. But generally speaking, it's not like stocks where you could just go on Robinhood and just swipe up. Stocks are a higher risk but still high reward investment. And unlike real estate, stocks are very liquid. So if you have a risk tolerance for, let's say, real estate, but you want the liquidity of, let's say, stocks, it could be smart to invest in both. And most really wealthy people own what? They own real estate. But what else do they own? They also own stocks. So I think combining these two investment strategies together can create a powerhouse for retirement for you later if you can commit to it. But that brings me back to the whole point of this video is what do you want to be prepared for? You have to look at your circumstances and decide what makes sense for you. So just make sure you have a plan so that way you don't make any emotional decisions that'll cost you in the long run. You shouldn't sell stocks just because they went down, and you shouldn't buy stocks just because they went up. Invest in what you believe in, and remember that delayed gratification usually rewards the best. Look at Warren Buffett. He's done 20% returns for the last 65 years. So he's the epitome of long-term investing. But anyways, that's it for this video. If you guys liked what you're watching, please go ahead and hit the like button, and you should even consider subscribing. And don't forget to hit the bell notification to get notified when I make videos just like this one. But that's it for today, guys. Thank you for watching. Thank you to all my new supporters, and I'll see you in the next video.